Hello and welcome to Insurance in Canada. I'm your host, Rick Pereira. So glad you can join me for another episode today. So, on today's episode, we're looking at three stories. The first one looks at drought conditions out in the prairies may affect the crops and the crop harvest. The second one we're going to look at today, we're going to look back to last year to the mine disaster at the Eagle Gold Mine in the Yukon. And our third story we're going to look at today, even though catastrophic losses have been piling up, looks like reports are global reinsurance costs. Looks like they may be on the way down, which is good news to insurance companies and to insurers as well. So without further ado, let's take a look at insurance in the news. So our first story today is out of Regina, looking at issues with the drought going on in the Prairie provinces, the hot weather causing drought-like conditions, the issues being with the crop yields and potential impact to claims when it comes to crop insurance. So let's take a look at our first story. Prairie farmers' crops struggling with yearly droughts. From Regina, it's the ninth year in a row, Quentin Jack Steets farm has experienced drought. The Southwest Saskatchewan farmer, who is the reeve for the rural municipality of Big Stick, says his crops are extremely short and he plans to salvage most of them for animal feed. They're not going to be able to make much of a yield, he said in a recent interview from his home near Golden Prairie, east of Saskatchewan-Alberta boundary. I'm going to scrape through and maybe be able to go another year, but I have a couple of boys that want to farm, and it's not something I would recommend to them at this particular time. Others are worse off, he added. It may be the end for them. That could be a 3 or 4 generation farm, which would be quite unfortunate to lose that much history and farms to begin with. I mean, the cost to start up a new farm these days is quite astronomical, so a lot of the time inheriting a farm is, for many people, the best way to try and get into farm or stay in farming anyways for a particular farm. Agriculture and Agri-Food Canada's drought monitor shows swaths of the country have been anywhere from abnormally dry to extremely parched. Trevor Hadwin, an agri-climate specialist with the department, said Southwest Saskatchewan, near their Alberta boundary, has been severely depleted of moisture for 8 years. This year, he said, pastures have dried up and ranchers are looking to buy extra hay they can't grow, I should say. Some have also reduced their herds or moved cattle to green pastures. Sometimes that's been 300 to 400 kilometers away, Hadwin said. For crop producers, we're seeing a reduction in yield potential. Crops are maturing much more rapidly than you would hope and will not provide as much seed content. Alberta's Peace River region in northwest, as well as the province's southwest corner, are also arid, he added. In Saskatchewan, Big Stick and neighboring municipalities have declared states of emergency to spread awareness of the drought. Virginia Meyer, the reeve of Enterprise, has said her peas likely won't produce pods, nor does she expect her durum to grow without rain. Everything is short. Everything is dying. Mayer said when drought goes on for so many years, it's starting to get depressing. She said costs for fertilizer and other inputs have been high while crop prices have been low. I think we'll be okay, but there are others saying, do I just get out, sell the land, and rent it and just be done with it? In the province's northern agriculture region, a dry spring is expected to cut hay yields by 50%, said Christine Strube, who farms and ranches northwest of Prince Albert. Strube said in a recent decision by the province and Ottawa to allow farmers to sell their crops as animal feed without getting dinged on insurance would be helpful. The key thing now is that we get some consistent rains throughout the summer, she said. Farm insurance and crop insurance, that's something I never got into, being a broker here in the Greater Toronto area. In my office is located in the western part of Toronto, so you'd have to drive quite a while before you reach your first farm, but that's always a branch of insurance that always interests me. So Jack State said additional changes to crop insurance are needed, including a per acre payment or a program that would allow farmers to salvage seed without getting penalized on their coverage. We've just gotten into a state where expenses are climbing, and at the same time our insurance coverage has dropped to a point where they no longer cover the cost of that farm. He said, we're not trying to be beggars or anything like that. We're just trying to make the government aware that our programs aren't working. Saskatchewan's agriculture ministry in a statement said the province is willing to work with Ottawa to discuss how they can enhance insurance programs. It said there are options available for farmers who chose not to divert their crops to feed. Hadwin said the summer weather outlook is not favorable for drought-ridden regions. There's still a little bit of time to recover for some areas, but other areas are probably in for it for the summer. He said Environment and Climate Change Canada's forecast predict a warmer than usual summer with uncertain precipitation levels. Bill Merrifield, a research scientist with the Weather Office, recently said human pollution has been a key influence on hotter summers. So I've not heard of anything this dire in Ontario, and it's unfortunate to hear this is happening in the Prairie provinces, considering the number of farms and number of large farms that exist in that area. It's important that we support those farmers and somehow try and keep them in, keep the farm going, keep it viable, because obviously food's important for everybody's, and if we can't support them, then where's our food going to come from? So, and like I said, trying to start a brand new farm, the capital outlay that you need to start a brand new farm, I know is quite substantial. So, like I said, anything we can do to help our farmers stay in business, that's always a plus in my book. But just wanted to bring attention. Obviously, when it comes to crop insurance, I'm not the expert when it comes to that, but I know it's essential for farmers. They wouldn't be able to operate without it, but I guess they still need a more diverse type of policy to try and look at other ways to try and provide compensation and not ding the farmers too much. At the same time, you have to keep the product as viable as possible. So there's always that balancing act with any type of insurance to try and provide the coverage that the insured really needs while trying to keep the product itself profitable and viable so they can continue going. Next up, we look at the last year's mine disaster in the Yukon. Yukon disaster, one of two most catastrophic in history. Insurance companies are asking about its future. The spill of about 2 million tons of cyanide-soaked ore at a Yukon gold mine was one of the most catastrophic failures in the 45 history of the heap leaching mining process and engineer task with reviewing. It said, Mark Smith said the disasters last year, the other occurring in Turkey, would define the next 10 or 20 years for heap leach practices in which minerals are extracted from piles of ore by running liquid chemicals through them. I had to do a little research myself to see what heap leach mining is. So I found this little website with this little diagram. Apparently heap leaching mining involves taking poor quality ore, so ore that doesn't have a high concentration of the mineral or metal that you're looking for, piling it in a big heap and then sprinkling some sort of chemical over the heap, usually some sort of acid. I guess in that case it was cyanide. Different types of chemicals to try and draw out different types of metals. So as the chemical goes through the heap, it'll leach that mineral or metal that you're looking for, and all the heap is sitting on some sort of semi-permeable membrane. In this case, this is a rubber lining. So as that chemical leaches through the heap, it'll gather, you keep it on an angle, and it will gather into a collection ditch. That leachate will be then processed to try and extract the mineral or metal that you're looking for. That same chemical, after the mineral metals removed, would then be used to recycle, go back on top of the heap to try and keep extracting that mineral. Meanwhile, you're collecting that mineral from the leachate that you've just extracted. So that's my understanding of how this particular type of mining is conducted. But last year, and there's a photo here showing the mine before the accident happened. You can see this little building down here. And this photo here, and this is from North of 60 Mining News, from their website. So this is the before the incident, the accident happened. And you can see the building down here and the collapse of the heap going down the slope. So that was the actual incident itself. Smith is a member of the independent review board that examined the disaster at the Eagle Gold Mine in June 2024 when an ore slope failed, leading to the contamination of local groundwater in central Yukon. He told a briefing hosted by the Yukon government on Tuesday that the board found several underlying causes along with the trigger for the disaster. Those factors included the poor quality of ore, an over-steepened slope, and a rising water table at the facility, as well as the impairment of a gravel layer that was meant to collect and move liquid, Smith explained. Together, they led to a large-scale liquefaction of saturated ore that triggered the massive failure in a matter of 10 seconds. Wow, that's pretty sudden. All 5 of those things had to happen at the same time for this catastrophe to happen. If we only had the first 4 and no liquefiable ore, it would have been a failure, but it wouldn't have been a catastrophe. The mine, located about 85 kilometers north of Mayo, has not operated since the collapse, and Victoria Gold was placed in receivership in August 2024. Victoria Gold, the owner of the Eagle Mine. Smith said the board found irrigation of part of the heap that started in April 2024 was raising the water table and would have caused material to start moving in the weeks prior to the massive slide on June 24th. Probably around June 1st, there would have been some evidence of distress on that slope, but there are no operators down there. This is not an area where people are going routinely, and there was no instrumentation on the slope, so they didn't know this was happening. If the irrigation sprinklers had been turned off, it may have stopped the failure completely, Smith said. He said the site has been operated by Victoria Gold Corp, had almost no surveillance, something that is far too common in the industry. We need better surveillance of these facilities. Smith told the briefing he hopes the board's findings and recommendations will extend beyond the territory, steering the heap leach industry toward better practices that lower the risk of failure. Asked if other mining companies had reached out to him after disaster, Smith said he was receiving calls as often as daily in the months that followed. He also hears from regulators, insurance companies, and investors about the future of heap leaching, he added. So heap leaching, there is some benefit to this type of mining, especially in areas that have the type of mineral or metal that you're looking for. But like I said, the ore is still not of a high quality, but it's still financially viable to try and obtain this, what you're looking for using this type. But there's also the risks as well that if some sort of disaster happens, it's going to cause quite the pollution damage just because of the type of chemicals that's being used to try and leach the metals or minerals from the ground or from the ground that you're mining. So once again, environmental impairment liability insurance, pollution liability, obviously for any type of mine is going to be a critical component of the insurance package, but not just for mines, other types of businesses as well. And doesn't take a large business to consider that type of insurance. Most liability policies, commercial general liability policies, are going to exclude pollution damage, environmental impact damage, except for a very, very, very few circumstances that would be covered. But for the vast majority of exposures, it wouldn't. So a robust type of policy is going to be important, not just to, obviously for mining, yes, other types of industry that deal with hazardous chemicals as well, but for smaller businesses as well that especially for, say, contractors. I recall a story maybe about 10 years ago, I believe it was in Vancouver, of a contractor that was digging in the streets. I forget what they were digging, but they dug too far and hit an oil pipeline that was being used to transport oil, and the entire residential neighborhood that they were working in, streets, lawns got covered in crude oil. So yeah, it doesn't matter what type of business you're looking at, except for obviously, I guess, office risks wouldn't be concerned too much with pollution liability, but definitely some sort of pollution coverage would be critical for some businesses, important for others. And our last story deals with global reinsurance costs decreasing. So for those of you who are not familiar with reinsurance, reinsurance companies are insurance companies for insurance companies. So reinsurance companies do not deal with the general public. Reinsurance companies are there to share the risk for insurance companies, either on an individual case basis for a very large risk that maybe an insurance company is not prepared to take on their own, or for part of an entire book of business for a particular insurance company. So it allows insurance companies to take on larger risks, as well as not have to absorb the costs of claims costs for their book of business all on their own. Obviously, they'd be ceding a part of the premium to the reinsurance company, but they also take a part of the claims costs with them as well. So part of the factor that a lot of people don't talk about when it comes to insurance costs, that a lot of people don't think about, is the cost of reinsurance as well, because the cost of reinsurance obviously has to be factored in when an insurance company calculates their own rates for a particular line of business. So insurers, the general public, might not be aware of reinsurance, but those costs do factor into indirectly, yes, they do factor into the amount you're paying for your own particular policy. So let's take a look at this particular story. So global reinsurance costs decreasing at mid-year renewals, Guy Carpenter. Despite global insured losses reaching $70 billion during the first half of 2025, including $40 billion in losses from the California wildfires in the first quarter, global reinsurers are reporting an 8.1% decrease in the cost of reinsurance following the April and mid-year renewals. Insured loss activity in the second quarter leveled off from the elevated first quarter. Global reinsurer Guy Carpenter reported on July 10th, losses for the first half of 2025 are now flat compared to the inflation-adjusted 5-year average. The Los Angeles wildfires accounted for $40 billion in insured losses, or 59% of activity in the first half of 2025. For reinsurers, the California wildfire losses are not expected to impair capital or appetite for the remainder of the year. So yeah, we're looking at events that take place outside of Canada, but don't be fooled. These events do affect indirectly what you pay for insurance here in Canada, just because Canadian insurers do use the same reinsurance companies, and these reinsurance companies tend to be large large global companies that operate on a global basis, not just in one particular country. So those claim costs that those reinsurers are experiencing in other countries can affect what the insurance companies here in Canada would be experiencing as well as for their costs. That's music to the ears of Canadian property and casualty insurers who dealt with $9 billion worth of catastrophe losses in 2024, a national record by far, but obviously far less than what even the Los Angeles wildfires cost reinsurers back in 2024. In the past, Canadian reinsurance brokers have noted the country's reinsurance market can be influenced by global loss trends, even though loss trends in this country do not follow the same path as in the United States. For example, in 2023, Canadian property and casualty insurers paid out about $3.5 billion in natural catastrophe claims, as Aon reported, and yet Canada witnessed a significant correction in reinsurance premiums and capacity. Reinsurance premiums soared while primary insurers retain more risk on their own balance sheet. Thus far, Canadian property and casualty insurance industry sources have said they do not expect to see a similar reinsurance market contraction. We picked a good time to have a bad year, as one industry source told Canadian Underwriter in June. Guy Carpenter's report, published on July 10th, appears to bear that out. The report measures the cost of reinsurance using the metric of rate on line, which shows premium as a percentage of policy limit. For example, if a reinsurance contract covers $20 million in liabilities and the premium is $4 million, the ROL, or rate on line, is 20%. Global rate on line decreased 8.1%. The United States saw 6.7% decrease, while Asia Pacific countries such as China, India, Japan, Australia, Indonesia saw rate of online decreases of 15.9%. The current trading environment is one of the most favorable for reinsurers in many years, evidenced by the additional capital being attracted to the sector. And we see this as a tremendous opportunity to rebalance the market dynamics in our clients' favor. More capacity will continue to moderate pricing, give clients more diversification of reinsurance partners, and provide better solutions to protect earnings. So always good news for the industry when we hear that reinsurers are A, decreasing rates, and B, willing to take on more capacity. It allows Canadian insurance companies to start relaxing their underwriting rules a bit, to take on more riskier properties, other types of risks that normally they wouldn't consider, just because they don't have that reinsurance capacity to help share the risk. So it's good for property owners, because maybe you have a property that's older. Most insurance companies wouldn't be considered that in the past, but now that the reinsurance market is a bit more relaxed, so can the insurance companies. So any good news is good news for both the insurance companies and the insured, and it's always good to pass on, because you don't see a lot of other good news happening when it comes to insurance costs these days. So good to see that the reinsurance market is contributing a little bit to ease your burden when it comes to your premium wallet. And that is it for me for today. I want to thank you for joining me. If you like what I do here, please like and subscribe for more. Don't forget to follow Insurance in Canada on Twitter/X. And until next time, bye-bye.